All right. Hey, thanks, Rich, and thanks, Dan, for letting me be a part of these. As we always do, I'm going to run through some sample marketing plans, wheat, corn, and feed grains, we'll call it, and soybeans. And I guess the thing I want to say is don't think of these as recommendations, but more as an outline. I think they're pretty good ideas. I think they're things you should consider. But the big thing is it's something that you need to compare then. Okay, hey, they're saying this, Mark's saying this. Why am I not doing that? Why am I more aggressive? Why am I less? And we're trying to give you something to think about with these marketing plans. So I'm going to jump right into it. Here's our sample pre-harvest 2024 wheat plan. Now it began back in October 1. So that's when we put this plan together several months ago. We have now priced our first increment, 10%. Our goal is to have that done by April 15. And I think last April 29th, I said, hey, we're going to do it at the close of this day, and that's what we did. So that's our plan. Our next increment is 20% at $8. And again, just a quick reminder, this plan is basically set up to price at least 30% of our expected production. And obviously in some parts of the state, our expected production now is much less than it was maybe when we planted it. So that needs to be kind of brought into your planning and your thought process. So where are we at? Well, here's just a chart. We did 10% on 429. We did that at 651. And I'll just tell you right now, that is below what our estimated cost of production was, our estimated minimum price that we wanted. At that time, I was getting very concerned that we may not see better prices, and so I wanted to get something on the board. Kind of glad we did it, but now we're ready for that second increment. We are seeing some pretty significant, I'd call it resistance at the 706, 708 area. We busted through that here the last couple of days, and now I'm hoping that is support. Today, we've kind of retraced a little bit. We're down. Last time I looked, we were trading at 721. That's down 10 cents from where it closed yesterday. But that area of now, I hope support at that 708 area is kind of holding, and hopefully we'll bounce that thing back up. So where do we go from here? Well, the thing we always say is, our date target's June 1, but in an uptrending market, let's let it play, right? So let's let this thing run. We're not going to pull the trigger on June 1 for sure, as long as we're continuing to trend upwards. But what I would like to see, at least in our plan, want to get that second forward contract in, get that second increment, so we'd be up to 30% priced. Would love to see that happen in that 740, 760 area. By averaging that all together, we would definitely be over our minimum cost, and we'd have 30% priced going into harvest. So that's kind of the goal over the next 3 weeks. Maybe get that last, percentage, that last increment put in there and get that thing nailed in. One thing I want to kind of share is this slide, and it's just something I put together a while back. It is the average CME July wheat futures price in the month of May. So I took the daily closes, averaged them all for that month, went back. I want to say, I think we went back to the last 15 years, 2004 to 2000, or I guess that's 20 years, 2004 to 2023, and just kind of XY graph that with the final U.S. farm price. And a couple of things I want to point out. One, this is just a simple XY chart, no other analysis. It does have a pretty good little R squared at 73, so that's why I'm kind of showing it. So, the next thing we might think about then is like, so where are we? Well, so far, and again, May's not over yet, but it's nearly over. We're averaging about 678. Now, again, obviously we're higher than that. Right? Today is trading around 721. But for the month, we're at 678, and that would imply a 633 price. And that can be kind of compared to where USDA came out this past May at $6. So maybe there's some opportunity for prices to strengthen. I do want to point out, though, as we look at that, that there's some years this model is off. Like this simple XY chart is off over $1. So really, it's USDA and where this model is setting is actually pretty close, within 33 cents. But it does say that maybe we might see USDA bump that thing up, and I think things have tightened up, and I think as you listen to Dan, that'll kind of come out. So next step, where do we go post-harvest? Well, this is a I call it a Salina-based on-farm comparison, because when we think about post-harvest wheat, what are our alternatives? Well, A, we can sell that grain off the combine, be done with it. We can sell the grain and buy a call option, so essentially re-own it with options. Or we can also then come back in and sell the grain. C, we'll use that here, okay? Sell the grain, and CME would call it a bull call spread. Essentially what we're doing is we're buying an option, right? That same option we were before, 770, but then we're going to sell an option, okay? And I'm selling an 830, so it's 50 cents apart. And I do that because that way I'm getting some money in and I'm lowering the cost of that initial option. And the thing I think the one we want to look at is, what are our minimum prices, right? What are the minimum prices? And if we sell the grain right now, it's 716. At least I did this as of yesterday. In Salina, cash wheat was at 716. B, that sell the grain and buy a call option, basically kind of leaves us there with a minimum of 640 because that option is so expensive. C, sell the grain, and where we're buying an option, but then we're selling an option, right? We're selling it, we're spending 75, but we're also getting back 55. So now I'm netted in there at 20 cents a bushel. My minimum is at 694. Maybe not quite so bad. The other thing we want to look at is those futures prices to break even. So for that sell the grain and buy a call, we would need futures to get up to 846, and that's the March futures, right? Currently, yesterday they closed at 773. So we would need to see, what is that, about a 60, 70 cent rise in prices just for that to begin to break even. So again, I'm not real excited about, selling the grain and just buying a call option. C, that sell the grain and buy a call and sell a call, isn't quite so bad. We really only need to see about a 19 cent price increase in futures. So if we think, hey, we listen to Dan, there's some bullishness out there. We could see futures pop up even more. We could see a 20, 30, 40 cent rally. That C, that sell the grain and put on a bull call spread, doesn't look too bad as a way of reowning. Now, the other thing we can do, though, is we can actually store the grain. And that's what I've got over here in the white area on the right side. Basically, I'm looking at a storage hedge. And so we're saying we're going to store it for 5.5 months. So just until at least get into the new year. So starting from, and we're beginning our costs at August 1, making the assumption that we'll have free storage through the month of July. Expected basis at that time in Salina is 20 cents under, or typically 18 cents is the 5-year average. I used the interest rate of 5 cents, which is a little bit higher than my example from last month. I think I was using 3.5. So that's something to kind of keep in mind, to kind of change that a little bit. As the economy continues to run a little hot, we're not going to see decreases in it. So probably 5% is a little bit better example. So I'm using 5%. That increased my interest cost 6 cents versus what I was comparing last month. And I'm using just a 1% shrink and then a 5 cent in and out. But if you look at that, where does that put me? Well, 773 futures minus 20, minus my 16.4 cents, minus my 12.2 cents, gives me an expected price of 723 if I would sell March futures, put on a storage hedge, and that would be an expected profit of 7 cents. So we're still looking at an opportunity here that we could put a storage hedge on and actually make money. Not much, right? Something to keep in mind, though, that's suggesting a 7 cent return over selling at harvest, but that's down 23 cents from last month. When I ran this last month using those prices, we were looking at the potential of a 31 cent return to a storage hedge, and I was pretty excited about it. Things have changed. What's changed? Well, cash prices, the nearby futures prices, have increased 90 cents over the last 30 days. March futures have only increased 74. So what we're seeing then is those deferred futures aren't rising as fast as current in the cash market. And so basically that market is kind of telling us they want our grain now, is what it's kind of saying. And it's making the concept of storage a little bit less lucrative. And I guess, to be honest, I'm not as excited as I was, say, 30 days ago on that. Now, this, again, is predicated to make this work. If you want to lock in 723, you would need to be selling March wheat futures. If you just store it unhedged, then you're literally just hoping prices rise, which is what we're doing with that C or B, right? We're selling the grain and hoping futures rise because we're going to buy a call. So again, very similar situation. But the thing is our bottom is a lot bigger if we store that cash commodity. And I think anybody stored wheat this year, 2023 crop, you know that bottom can kind of fall out and you can really lose a lot. So where are we at? I kind of like this whole idea of putting on that bull call spread, which is buying an at the money call option, pretty expensive, but then selling an out of the money call, which was bringing me quite a bit of money too, as I looked at that yesterday. And that lowers what your net spending is on those options. It does put in a ceiling, right? Puts that ceiling in there at about the most I can make on that is 38 cents. But that's a pretty nice return. So a sample post-harvest wheat plan would be this. Deliver the 30% that we've got forward contracted, right? My goal is to get another 20% forward contracted, say, over the next 3 weeks. So then that I've got 10 plus 20, that'd be 30%. I think in your slide it says 20. I messed that up. It would be actually 30. And then sell all the uncontracted bushels at harvest and consider a March call spread. And I'd say 50% of production. Why am I doing this? Well, I think seasonal trends suggest that prices typically rise from May into June, but a lot of times we see prices weaken July into, say, December. So the seasonals would suggest that it's not a great idea to do that. Also, when we look at the current futures, that market carry has lessened. And for me, that makes wheat storage a bit more concerning than a month ago. March call spread at current levels would allow for the opportunity to take advantage of any significant price rallies at less cost than that simpler, just straight buying a call option. I think the other thing is your break-even futures for the call spread is currently 7.92, which is, maybe 30 cents higher than where we are. So a nice pop up in prices, and we're breaking even if we do that. Potential for grain was 38 cents. So once you implement this plan, you'd want to set a profit goal. To me, the maximum gain is 38. Hey, if I can get 20 cents, let's grab it and go and be done. And a date to close out, let's say if I'm using March options, let's close this thing out in January, end of January, 1st of February. Those would also need to be a part of that plan. So that's kind of where I'm at on the wheat side. When we look at the feed grain side, here's that plan. We began it January 1. We had very aggressive price targets, 565 for the first increment, going up to 625, 7, and 725. Anyone who's been watching futures knows that's not happening this year. This is kind of a bad year. I call it a crap year. Prices have actually trended lower. But we want to have 20% price by June 1, which is just 3 days away. So one thing I do want to point out, I apologize, I got this slide here. One thing, and if you've ever listened to me talk, we always do this. I look at the last 15 years. And this chart, under the January 1 here, we've got, that's what the price was on the 1st January, or the 1st of January, first trading day of January. So, for example, on 2012, on January 1, it was at 590. 2011, December corn futures were 590. And then the next column over is the maximum pre-harvest price, which is basically between Jan 1 and September 30. And so in 2012, the maximum price got up to 839. We saw futures rise a lot. And so we saw a $2.49 rally. Well, what I did here in this chart is I ranked them. So we can basically say that in the 27% of the time, we're going to see at least a $2 rally. 53% will see at least a 65-cent rally. 73% will see at least a quarter. And then we've got those crap years where we see 0 to maybe just a little bit of a rally. And I want to look at those years individually. And so here's all those years charted: 2009, 2023, 2013, and 2020. Now it says 500 because those are in cents per bushel. But if you look at that gray line of mine, 2023, it does show that, there we are, end of June, we did see that opportunity where we did get prices back up above or where we were in January. So even in those years where we see very little, that market does give us an opportunity. We also saw that in 2009. In 2020, it was way below all the way, but post-harvest, we actually did see prices get above where they were in January. And I guess where I'm coming with this, I just want to show that we are looking basically probably for a very small rally, I think. I don't know. Dan says there's a lot of risk out there, and I sure agree. There's a lot of things going on, but prices have really trended lower. We are in an uptrend right now. Here's December futures as of yesterday, right? I want to update where I'm at on my thing here. When I last checked about 11:30 this morning, we were at 480, down 5 cents. I went ahead and priced 10 cents or 10% at on May 14th at 491. But the thing I want to point out is we do have a gap in the futures market at 502. It actually occurred on that first trading day of January. We have yet to ever get back to where we were on that first trading day of January. And so that's an area of pretty significant resistance. We've never gotten up there. We did get up there a little bit above 490, 495, that 498 area for a couple of days. We've dropped that down. We're kind of attacking that again. I guess where I'm at is that, we need to break through that. But then after we get through that, there's going to be another set of resistance at the 520. So there's some relatively strong resistance from a technical standpoint that I think are going to make it difficult. Now, we are in an uptrend. We want to ride that uptrend. So I think as we look at this, and so what I did was I priced half of our first increment. So we're trying to price the second half of our first increment. We haven't really priced much yet. I'd like to do that anytime we can see a close above 510. If I can do that, get that other 10%, my average would be at $5, which would then be at my minimum. And I think that's a good place to be, to get something on the books just in case we get this corn crop in good shape. We don't trade as much as we think, and we do have a decent sized crop. Again, a lot of risk yet. A lot of things could happen. This is very early. We've got a lot of time. But it's sometimes kind of nice to get something on the book that you can start pivoting off of and working off of. So that's kind of where we are there. Kind of the same thing on soybeans, a very similar plan. Wanted to price 20%. We went ahead and priced half of that again. May 8th at 12.13, which is $1.13 over our estimated cost of production. So I think a person should feel good about pricing at these levels. Again, same kind of thing. We're seeing a significant gap. Prices have never gotten as high as they were back on the first trading day of January. So we have never traded where we were last year, let alone the first day. And that's going to take something to get through that gap. I'm not saying we won't. But I believe this is a pretty good opportunity. We're moving towards this area of resistance. And so as I look at this, maybe that second half of my first increment, want to have done by June 15. So I've got roughly 2 weeks. If I can see a close above July or in November futures above 1220, I would definitely lock that thing in as I look at this. With that, I'm going to kind of wrap things up. I want to thank everybody for being on. And if you listen to our webinar, the recording, I hope you do. The other thing I want to point out, though, is look at 2025. July, hard wheat. This is as of yesterday, 757. December corn was at 491. November soybeans 2025 was 1185. We always start January 1 of the year. There's nothing saying that you as a producer could look at maybe taking some action well in advance. So with that, I'm going to stop the share on this thing and turn everything over to Dan. Thanks so much.
Thank you, Mark. Mark and I, probably one strength of having more than one person on here is that you get to banty ideas back and forth. And we've been, at least I'd been a stickler of holding strong to the idea of never pricing below full economic cost of production if you can ever help it. But then again, as we've gone back and forth, there are different measures of cost of production. There's direct cost of production where we cover all cash costs, and then have fixed costs. And we K-State put machinery costs and land costs into that fixed category. We hope to cover living costs by some of the labor charges that we have within the budget. However, if you're hiring that labor, not paying yourself, then that's I guess that is a weakness of that concept. So I'm thinking that I have the I see the forward contract prices available right now and across the state of Kansas. Just you look at for corn, the high forward contract price for harvest, $4.99, 14 over. That was yet on yesterday's market down in Garden City area. Then you're ranging a lot of prices in 454 to 469, 479 in Hutchinson, 469 Salina, a little lower elsewhere. So those the competitive way to make money in those situations, to make a profit, is to have just outstanding yields, and in order to basically take all the costs, especially the fixed costs, and spread them out over as many units as possible. So if we are going to be, Mark, as you indicated, if it turns out that some of the risks that I think are out there don't come about, then I hope we have tremendous yields, just able to help us to protect ourselves on the cost side. Just and would say too that the forward contract prices for sorghum, we talked about corn, they're a little higher. Well, about 463 in the Colby area, Garden City about 449, Central Kansas 454, 458, weaker than that, closer to 416 or so. In Columbus, that was yesterday. So again, similar situation, a little different cost structure on the sorghum side. Of course, those planting decisions either have been made or they're coming soon, and particularly if it's non-irrigated sorghum. Soybeans, I guess we're thankful for the costs that don't go into to soybeans, that allow us to have break-even opportunities in market. Just as you pointed out in your marketing plan, gosh, we've got some profitability even at levels that we've seen better than before. Again, we're basically ranging across the state from a high of 1164 in Hutchinson, 1148. Columbus area, one major elevator having that, 1145, Salina, Topeka 1139, 1105 out in Colby, 1120 Garden. So soybeans with their cost structure and enable them to be a pretty good target, and that of course they work better on non-irrigated in central eastern Kansas than do out to the west where it's an irrigated enterprise largely. And then for wheat, so here we're coming into wheat. The USDA has the season average price projected at $6 for the new crop marketing year, and that new crop marketing year starts June 1, just a couple 2 or 3 days. And the forward contract bids are well, the highest bid in the state, Hutchinson again, $7.11, 34 cents under and I've got those off of the September contract, basically figuring that if we're going to harvest in July, that what we'll be delivering against at an elevator will be the next contract, be September. So 34 cents under September. Then you have 696 in both Salina and Topeka. Again, 49 under there, and weaker elsewhere, 676, 666 in between Colby, Garden City, and Columbus. And Mark, if you're still on, what was our break-even price for wheat, particularly in the West? Do you have that number? Because I think that it's not $4.50 or $5. I think we're at $6.50, aren't we? Or basically, I know that anytime you include fallow in a rotation, that you really raise the price, and that's what hurts the cost of production issues out here in the western part. So
Dan, you're talking wheat?
Wheat,
the break even or the cost of production was $6.95, and Northwest, Southwest was $7.35.
Okay, so we're, and that's full cost of production, land, machinery, all the direct costs, etc. So we're even at the prices that have come up, we're approaching break even, but we're not there yet out to the west. Do you have a Central Kansas number?
Yeah, in the Ag Manager budgets, North Central was 598. Okay. South Central was 507.
Yeah, so North Central.
I'm sorry. Well, things to point out there, like in that Northwest yield, 60 bushels to the acre. Southwest, 54.
Yep.
North Central 62, South Central 62. So, I think we're going to see a lot of these areas that you put the costs in, but we may not be getting those yields, right?
Well, that's just again out the farther out to the west you go when you're again trying to cover fallow, that's an issue, and that's the economic incentive to go no-till and try to minimize fallow or go 3 out of 4 years. So let's move on here. Okay, all right. Okay, let's take a we'll show you some of the highlights. Again, you all have the presentation to look at. If you'd like to see the so in terms of the U.S. Drought Monitor, you can see that the main dry area in the country would be out in our part of the world. Even with some of the rains that we've caught, South Central, Southwest, parts of Northwest Kansas, etc. Some dryness up here in northern, northeastern Iowa, but for the most part, not a lot of dryness. Some issues to look at up in the Pacific Northwest where there are croplands up in there. And here you got the tail of two soil profile levels on the for surface moisture across the country. Hey, things are looking pretty good. When you see that the short-term map for it's a composite map for weather conditions. In fact, lots of moisture. Although it's not verified in the latest crop progress report, there were some market reports of delayed planting up in these northern states. It doesn't seem to be verified by the numbers, but in some cases, the concerns about crop insurance states. So I suppose if you're right in the heart of some of these wet areas, that could be an issue. But you still have the underlying soil profile, long-term composite view of things being pretty dry in some of these same areas that in the short run are pretty wet. So I guess in trying to look at this from a probability distribution perspective, and taking into account some of these same issues that have been projected in terms of projected weather effects, I think we look at the possibility of La Nina forming and coming out and causing late summer weather as something that may or may not happen, and that's true. It may or may not happen, but that's so for our marketing plans, if we do get dry later on, as even as well off as we are doing right now, as crops getting in, etc., and we're looking at we have moisture and all, then it seems to me that we don't want to bury our heads in the sand with regard to what could happen. And those pricing plans that we have for and those lofty price goals, they seem sketchy right now, or not a lot of likelihood of hitting them if we have the same weather we have now all the way through. But yet we have this weather forecast out there that's come into play, and if that happens, and you see these areas that have underlying drought conditions, then it's something to look at. Of course, this isn't necessarily the same thing as a soil profile, but it is indicative of long-term dry conditions and probably some risk of dryness down to the south. What's interesting to me also is we're seeing serious drought down in, down here in Mexico. If you can see my pointer, and read in market news this week, some of the corn that's been brought that's been bought export wise from the U.S. A fair amount of it, predominant amount of it has been going into Mexico, and their best corn producing areas are dry, and so you've got that going on. You still see this dryness in different parts of South America. Here's down in here in this part of Brazil is where the floods, crop damage been happening to soybeans, etc., all in play. So and some of that is also hit at Argentina. So I guess it's a question of what portion of the crop are we talking about? And I'd seen a number 2 to 4 million metric tons. Of course, they projected to produce 100 and get my crop right, it's either 120, I think that's corn, 150 plus for soybeans. But then again, on the margin, that's significant. And there's been crop damage from either frost or I believe dryness. It basically a scaling back by the market that the USDA is in the process of figuring out up in Russia. Some of that bleeding over into nearby countries. So that I would contend is probably as a major issue in the wheat market right now. Again, the fear of some type of at least a diminished crop out of Russia, who's been predominantly, I guess if you call them a price leader, they've been pretty much with large supplies at low prices, just pretty much dominating the wheat market. You don't see it in major areas of production in China. You don't see a lot, although the North China Plain, gosh, it looks dry to me. But we'll see. We'll see how that works out in terms of their crops, and generally not thought to be a poor crop year in Australia, especially to the east, although the west showing some issues. Okay, so I'll try to hit on main points in this, and I do want to show you kind of my own thoughts on the risks and possibilities in the market. You can see here let's see, Rich, I have one question again. How do you hide that? Is it hiding the video panel? Is that what you do? Get rid of that top part?
Yes. Or, well, not your video. It's the I don't remember the exact name of it. There's another option on there. I can't access it with you sharing.
That's all right. I'll be fine. Anyway, so here's July corn, and let's see. Okay, there we go. So you can see some of the action we've seen. In coming February, we were in this long downtrend. Well, now we've kind of had this tortured move to the higher side. When we were here, well, it came up, came back down. But as it's continued out here into planting season, we've gotten from lows basically of about 425, 421, 422 up to highs of about 475, closed here yesterday, 462. I think it's down a little bit today. So you see an uptrend, and that's in the lead contract. And of course, today we're talking a lot about both storage and for old crop and pricing a new crop. But that on yesterday's close for May 28th, it makes you go back and look and make sure you've got things right. But we had Dees corn closing at 485, and then post-harvest carry about 4 cents. So it looks like a market that is pretty much, again, May futures off the board now. It closed mid-May, but you look at the carry from the close of May into June, and then to September to Dees. Basically, we're in pretty much a 4.6 cent carrying market all the way through that, and that it's so consistent that it must be in the minds of traders as they're looking at these carries. And we've looked at this in the past also. You might note that if we look at where from 2004 coming up to the present, when we've tended to be in a lower price mode where we traded at, and it seems if you draw a ray right through the middle of it, it's about $4, and that makes sense. 475 on the top end of this generally low price range trade, 3 on the bottom, and it hasn't been that long ago we'd go down to that and touch it. So now we're at 461, or we were as in terms of the monthly close 461. That's 1 quarter, I guess, to 3 quarters. That was a number I pulled up earlier today, I think. So So we're in the top half of that range. You brush down to 4, kind of hanging out in here. So Mark, as a pricing perspective issue, when we had those aggressive plans that we had in the first of the year when we started out, they were based on our reference prices were these. Now we're down into here, but now I'd contend our cost of production is about here. Is about the 475. So we're down into these areas, kind of the top half of kind of the lower price scenarios regime that we've got, and are wondering about the possibility of moving higher or not. If we have a great crop, where do we go in this deal? Well, you were probably in the 4 to 475 range, I would think, and hopefully not lower. Did want to show you the spec positions and how they've changed here of late, and just note that when prices were moving down so aggressively from 803 at the high, that was actually back in January 2022. Then it got into January 23, 678, 698 thereabouts, had fallen down to 408, and now have come back a bit to 463, and we're wondering about price possibilities. And note, while that had happened, as all this was falling off, that the bearish positions came down to touch at as short, as bearish from the spec position, as we'd seen basically at just a little over 2.5 billion bushels of sell positions, and now we've come off of that. Still quite a bit though. So to me, it looks like we still have pretty much a very cautious view about prices ever going up with the traders' positions right now, and they see the USDA numbers, and they're projecting 14.9, 15 billion bushels of corn, 181 bushels per acre. So if that is where we come about, barring some other international catastrophe crop-wise elsewhere, then it puts us into this generally 4 to 475 price range. And I would say that now the USDA is projected for, well, this is a chart, a monthly chart, and in the brown, you see on a monthly basis what percent of the season average price that we had had seen in terms of monthly closes. And some of these are history, some are still coming. So basically we have the numbers through March, April coming soon, and so we have actual cash prices to this part through March, April, and then these are futures projections. Again, a little bit of positive carry on that, and the USDA is projecting for corn, in essence, a season average price this year 465, so 470 is by the way the numbers calculate out. So that's how that price worked out. But here they're projecting for the new crop marketing year, the USDA's projection $4.40. The futures are basically hanging around $4.95 to $5. So they're coming in September, October, November, December, pretty flat all the way through. Again, my contention on the futures is that we must be really front loaded in our perspective on the markets. We're just pretty flat thereafter with a little bit of carry, not anywhere representing anywhere near the type of potential upside that can happen. And then even with that, and you show a positive and support through June, and then are coming down a little bit into July, August. So anyway, you've got our current situation is, and these are current cash prices that the market, as they sit here today in May, they're showing that, well, there's a possibility of a little bit of price run, but they're not accounting for much risk at all. And you can see as these percentage moves are dwarfed by the types of price volatility that we've seen historically during these timeframes. So that's that, and this is pretty much the case across all these commodities. So what I'm going to shift to here pretty quickly in the interest of time is my own thoughts on where these markets could go. Okay, so we've talked about corn acres. Most of you are familiar with that. There'll be another corn acreage, the USDA corn acreage report come the end of June, and that is the last trading day of June when that number comes out and that report's released is a potential day of volatility. And you do see again the USDA's projection that the markets are paying attention, that they are paying attention to, is for 2024, 181 bushels an acre. We haven't been over 177.3 ever. So I'm hesitant to just get on the bandwagon and say, yeah, 181. It's, you know, we trust genetics for this for the long term. When basically, if anything, you can build a pretty good argument that, hey, nationally, we're kind of, gosh, we've had a hard time getting beyond this 176, 177 time frame. And you can see planting and emergence generally on pace, and the numbers verify that. Projection in the old crop mark for the 2023, we had 15.34 billion bushels. Latest projection, basically about 14.9. Pardon me, just under 15. And ethanol, you can see trade exports doing decently. Again, competing, they'll unless there's a shortfall when the South American crop comes in, we will tend to trail off as we get that competition. And in terms of ending stocks to use, just over, basically we flirt around 2 billion bushels in this old crop marketing, or I'm saying there's about 80% chance that's right. 2.1 billion bushels, about 40% chance that's right, basically because of just acknowledging how difficult it's been to get anywhere near 181 bushels an acre in the U.S. 2.1 billion, and that's the acres we have. That's 181 bushels per acre. If you get all of that, given expected use, you're basically at just over 2 billion bushels. And with that, so you can see that USDA's projection with the finishing up the old crop marketing year about 465 as an estimate, 13.8% stocks to use. They're projecting $4.40. The futures, as we showed earlier, the futures projecting about 496, 495. So here's would be where these are, I guess, my thoughts on old crop and new crop. On old crop, 8% chance. Yep, again, 4 out of 5. Yes, USDA is very, very likely right. And if anything, if they miss, it'd be that that low prices maybe are underestimating ethanol and exports. And so you take a total of 50 million bushels, add that to usage, take that off of stocks. You take this 2.002, basically just over 2 billion, you turn into about 1.98. A little bit of change, price goes up about 30 cents. And again, futures projecting 470, for USDA 465. But probably in the interest of what we're talking about today, probably more the issue of what do you think of this USDA projection, 181 bushels an acre and 2.102 billion bushels ending stocks. If you go in with the previous, that's in my own thinking, is 4 out of 10, 40% chance they're right. 6 out of 10 is something less. And so I'm lumping all that into the previous record high, 177.3, and doing no changes on usage, you end up with 1.8 billion bushels, 12.2% stocks to use. And if you look at the relationships, you're looking at something closer to 550. Again, that's not $7, it's not $6.95 or $6.70 or something, but 90 cents higher than where we're at. And again, the futures are basically cutting the middle. They're looking at $5, which is just about halfway between the two. So Mark, that's my contention. Yes, if we could very well, this could be the path all the way through on corn, and we end at $4.40, which would be pretty low harvest prices. I think there's at least a coin flips chance that they're pretty optimistic on that yield, and that we'll get still production of 14.6, 5 or 6 billion bushels with the same usage. You're a couple hundred million bushels below 2.01, and again, historically, if you look at the relationships, it's $5.50. So keep that in mind, I guess.
Hey, Dan,
Yeah.
but when we look at that, then are we saying that basically December corn futures come, I don't know when exactly, will be 550? I mean, like zero basis?
Oh,
The December futures are basically going to be one and the same as I mean, ultimately, I mean, there's always this thing called basis, obviously, and so I guess like 550, man. What kind of a obviously we'll run some positive here in Kansas, but like I guess where I'm heading is like, where do we think, how high can futures go?
well,
Or are you thinking basically cash is just going to have to catch up with where futures are?
in that projection at 496, I do have a kind of a national basis estimate. In there, in essence, take the most current basis, current full month that I've got, and in terms of U.S. average cash prices, and compare that to the average of futures, well, across the futures complex for the for the next marketing year. So there's a national basis estimate in there, so the 496 it's a national average cash price is what it is. It's given futures and a basis adjustment. So it's not like saying, well, we've got a 50-cent basis, 45 under in Kansas, so that means 496. Well, that's 450. No, this is a national. I'm trying to get at the national U.S. average farm price. But
Okay.
but to what you're saying, what would futures have to do for this? Somewhere out in there, you'd have some volatility, or just realization. When does the USDA come in and actually adjust their numbers? Well, they probably don't do that. They may not do that until they actually get out in the field. They're hesitant to do it in August because it's early. That you may not see that change until September, October, when they actually get out in the field and measure numbers. Now that if there is damage, the independent market, they'll be on top of it. They'll raise futures up before the USDA comes in. But if the USDA comes in and verifies, then that's when you see the volatility. That's at least how I piece that together in my thinking. So let's go on. And I want to show you in the interest of key high points here. So we've been debating about the size of the Brazilian corn crop, and it's not the 2024-25 marketing year number that USDA just came out with that's relevant. It's the 23-24. Their crop is in the back half of this September, August through August marketing year. So this you'll see you have hotly debated numbers. Is the USDA right, or are we 2 to 4 or more million metric tons too high? And 4 million metric tons too high. If in Brazil, when you come back and look at what that would do to the production, well, instead of 1.22, these are millions of metric tons, a billion billions. So it'd be, you take 4 million metric tons off of that, probably about the same usage, and you start to move this lower. You wouldn't have as much of an impact as when we were really tight back in here, but it would have some impact on the markets. And are some similar issues in Argentina. Okay, so let me move on. Okay, soybeans, hit the high points. We have seen, similar to corn, a run up of late. We were trading down about $11, 30, 35, 40 cents thereabouts. Had gotten up to about $13. Well, excuse me, about 12.60, 12.55, 12.60. Currently trading at about 12.29 and a half. I think the news that's come in has been again these lingering issues of what the size of the Brazilian corn crop is, and the floods in Rio Grande del Sul that will have major impact in that geographic area. How much of a broader impact on the world supply demand situation will that have, is the question market's trying to wrestle with. Just as for corn, you kind of look at where we're at. And on the soybean market, we had gotten down, touched into that, I guess the lower price market regime area, but with what's happened in South America and lingering questions, we've come up above that again, but still at risk, I guess. Very similar situation for soybeans as for corn. You can see the deep selling positions that we had started to climb out of that a little bit to move to the high side, but still a good number of folks that well, we're basically becoming more towards neutral in terms of buyers and sellers on the spec side and their positions. But certainly we've come through a time of a lot of pessimism, and given that we've just been there, it may not be difficult to go back if conditions warrant. USDA's projection for new crop, excuse me, for new crop 2024 is as a price $11.20. The market numbers, again, and so this is kind of going back to what we calculated on the corn. So I've got a national average basis in this calculation, and so it's not just all futures, it's futures adjusted for basis, and again, very, very flat. So we're coming through in the bluish purple, the old crop marketing year, pretty flat there, coming down, but 96% of the season average price projected for August. Then you switch over to the red, and that carries right over there, and from there just flat. And again, the markets are myopically front loaded. They're not looking at anything akin to the type of seasonality and risk that we've had in the past. It's just a flat up front, and then a little bit of carry, a little bit of adjustment for where we're going on these. So to me, that's it. That in my thinking, it says that they have a narrative, they're holding to it, and until they have any evidence to the other side that would show anything different, they're going to stay with this. And again, and so for old crop, for the current marketing year, the futures about 12.60 as an average. The USDA's season average price 12.55, so in essence equal. But again, the markets are about 90 cents higher with this their projection, by my calculations, about 12.10 than the USDA's projection of 11.20. And the acreage issues, we've talked about that. Yield, again, a projection of 52 bushels an acre in recent history, that would be a record. 51.9 in 2016, previous record. So we might get it. We've spent a lot of time in this around 50 bushels an acre, 49.6 in low side, 49. We've been there before, but not a lot of variation from that when you bring the national numbers in. Projection about 4.8 billion bushels off that 52 bushels per acre figure. That would be the highest since we had back here in 2018-19. So we might get it. That's for total supplies. Production 4.45, and again, that would be just under the record that we had 2021-22. So and that's what the USDA does. If my good friend Doug Bounds is on here, we take and we assume normal weather all the way through. So as long as we know that, then we can say, well, yes, here's the assumption based on normal weather. What's the likelihood that we don't have normal weather and don't get that? Planting emergence. Again, you can see the general trends, not major concerns. Exports doing decently, but again, looming South American, Brazilian crop coming in. And we've looked at this last time. Again, the growth now in bioenergy usage, leading to more crush, projected to go even higher next year. Exports had been going down, projected to increase in 2024-25. This is closer to what we have in hand. This is what's hoped for. So we'll see if that actually comes about. So right now, projection 10.2% stocks to use off of for 2024-25. Prices continuing to move down to 11.20 as that USDA projection. And here would be my own thoughts on that. I think, again, we're so far into this marketing year that really, if we get these changes in the current marketing year, say 1 out of 5 chance, it's because there's what's been rumored in South America actually is true. And the Rio Grande del Sul losses, they're tangible. All that comes into play. So you basically take index stocks from 340, say take 70 million off down to 270, still 6.45% stocks to use. And with that, you look at how that change in stocks to use affects prices. It's about $1.40. Market's certainly thinking this. But then for next year, really with only one change, if you got the major change is basically from 52 to 50 bushels per acre, and so you bring that down some, and then with a little bit lower supplies, you have a little bit of rationing that comes into place, the lower domestic use, the lower exports, and you end up with a little higher price to ration lower supplies, and you've got about $1.70 higher. Markets thinking 12.12 as we had stated. So somewhere between these two is about where the market is thinking. Pardon me. So let's go to wheat in the time we have left. So wheat certainly come up. You look at we had the low of about 545 or so back here and heading into early March, have jumped up now to just below 750, closed here yesterday at 731. I think it's down about 810, but a lot of bouncing around, volatility all occurring, and but strong uptrend. And some carry about once you get past what we've got again from the closed out May futures into where we're at now, about on these months about 3.6 cents, but then a little more carry. So Mark, what you were talking about for wheat, you're getting into this train of thought here and trying to figure out which months of if you do a storage hedge, basically, are you going to get your gain in? And as you carry that, the longer you get, and I noted you said basically get out had a position you're going to get out of in January. Well, if you do that, you'll have taken most of the gain off of these, getting almost 7 cents, 5.5 thereabouts, and you're down to more normal returns to storage. So in terms of wheat, longer term view, we had gone deeper, and basically we've been living in the last several months, been living in the 550 to 725 range. But interesting to me that we've just on yesterday basically closed at 723. We're peaking off into these areas. So what made this happen? Well, COVID-19, that came into play on some issues on commodity markets. the Ukraine-Russia war came into play there. And now what's bringing this back up? Still some issues in the Black Sea region, largely in terms of worrisome supplies. And you have seen some, again, what's so telling to me, and when you look at the positions of spec traders, is that you just change the scale and it's almost the same herd behavior in these different commodities. So they're and the prices and the relative proportion of contracts seem to be about the same. Again, you can see the pessimism that we had. We got down to 563 in those positions, climbing out of that some, but pretty strong run up in prices. Some also noticeable, but not as much of a decrease in or a buying back of the short positions as you might expect. And USDA's projection. So Mark, this is my sure open for your thoughts on this. The current marketing year for wheat, USDA's projection for their price, again, this season average price is well, let's make sure I've got the right thing here. You're right. Okay, 710. USDA's projection, current futures markets, by the time it closes out about 694. Their projection $6 for that next marketing year, and the futures trading over $1 higher. And futures with a basis adjustment, a national basis adjustment, about 738. So we have some difference of opinion between the again conservative USDA projection and what the futures are looking at. And see, we continue to be hurt by hard red winter wheat export issues, just not moving anywhere very well. You do see all U.S. wheat moving pretty good. Most of the classes aren't moving well, except for soft red, which is going tremendously. Food usage and weakness in exports, again, a projection that'll improve, and I hope it does. We'll see. So here's that USDA projection about ending stocks, 40.3% versus the price of 6, and that move lower to lower side. It's interesting. If you had the futures number in here, we'd be looking at about 710, well 720 up here instead of the $6. So and here would be probably just about pretty coming into the last slides. USDA's projection, there's a $6 figure, 766 million bushels, ending stocks 40%. And just in thinking about what else could go on, this is for the new crop marketing year. This starts June 1, goes until May, through May 25. And instead of 48.9 bushels per acre, projection for the new crop marketing year 47. Again, we still have to work our way through the spring crops and see what the final number is in hard red and soft red. This is, say, 50% chance USDA is right, 15% chance yields get knocked down. That's reasonable. With what's happening overseas, and if the Black Sea region has major production problems, which is increasing possibility, if you raise the projection of exports from 775 to 850 and just let the requisite changes happen, instead of 766, you're down to 691, 35% stocks to use. Instead of $6, you're more like 775. And if you get both these together, both higher export demand and moderately weaker yields, then you're 620 million bushels, ending stocks 31%, and you're at a price nationally where even hard red winter wheat probably be able to make money off of prices on that. We wouldn't. That's a aggregate over all the classes, but hard red would be helped in that. So there you go. And just do want to show one thing. So in the May report, the USDA did give their first 24 23, 24, 25 marketing year estimate for world stocks. And, we are basically continue the issue we've been pointing out, 17-year low in world stocks use. This is world less China, 121 million metric tons, and stocks use of 18.6%. And that's continues to go down. And you've got this world situation that's in play where we've seen world wheat stocks continue to move lower. I think our U.S. hard red winter wheat export troubles really are front and center in our vision of where things are going. But this continues to go down 18.5%. You're getting to the place where you're almost within shouting distance of the historic low back in 2007, 2008 of 17.7%. So I don't know. You don't want to just use hyperbole, but somewhere out there, this will be a concern. I'm not sure when that is, but we're not really seeing it in a major way in the wheat market, but it's there. Okay.
Ward does have a comment in the chat, Dan.
Oh, he does. Okay, well, good.
You both sound a little more bullish than you have in the past.
Well, I wouldn't paint Mark with that. He doesn't have to, but I it's not that I just think that our USDA numbers that we've come forward haven't changed much, and yes, I understand that we have to assume normality going forward, but there have been there have been issues in the international market and in that have occurred in the U.S. Situation that are projected that I don't think that markets have been forced to deal with yet. And I understand that. We're myopically speaking, they're not here. So why worry about them? But I guess I suspect my own opinion is that we have a fair profile of risks, at least on the production side in the U.S. that we have to deal with, and we're really not paying much attention to them yet.
All right. Anything else, folks?
Well, I tell you, my only 2 cents on that is yeah, I'm probably a little more bullish than maybe I was, but I'm not, as negative maybe as you might think. I mean, I'm suggesting, hey, we ought to have maybe 10% priced. That's the idea. There is, hey, we're going to price the other 90% later, right? Waiting for prices to rise. But at some point, I think one of the nice things about a marketing plan is that you set those dates and you kind of take some positions, and it isn't, the goal isn't to sell it all at the highest price, because I think we're always going to miss that, right? I think the goal should be to try to spread those sales and use these opportunities when we see rallies and things like that. So yeah, I mean, at this point, the plans I outlined, we've only got 10% priced. We're still keeping our powder dry with quite a bit of that crop here, waiting for things to take off.
And I'd add to that yes, I'm if you call saying, hey, we've got risks we have to deal with being bullish, and that they probably affect prices, then that's there. That the big bearish risk is that none of those things happen, and we come into harvest and we get 15 billion bushels and just so usage, and then we have a historic price low. So that's our risk. So even at Mark, when we do winning the game workshops, we'll run through these things and we'll look at opportunities, and we'll grimace over 10-cent moves, in on paper, and then by the time the harvest gets here, the thing dropped $1. So I guess that's the challenge of dealing with these decisions under uncertainty, where the big risk is out there in the fall if we do get large crops and just so usage, and then we're on the low side, and we look back on these prices as that we weren't that excited about, and gosh, wish we had some